The three inside down bearish pattern. The characteristic of this pattern, that is the market is in an uptrend or a move higher. The first candle is a green candle with a large real body. The second candle is a red candle with a small real body that opens and closes within the real body of the first candle. And the third candle is a red candle that closes below the close of the second candle. The uptrend continues on the first candle with a large rally posting new highs. The second candle opens within the prior candle's trading range and closes below the prior close and current open. This causes concern for the buyers who may start selling their long positions. The third candle completes a bearish reversal where more long positions are forced to consider selling and short seller may jump in to take advantage of the falling prices. This type of patterns doesn't need to be traded. It can simply be used as an alert that the short-term price direction may be changing. For those who wish to trade this pattern, a trader could enter short near the end of the day on the third candle or at the open the following day. A stop loss can be placed above the third second or first candle high.